Hello, everyone. Welcome to part one of Jewish National Fund's Plan Giving Speaker Series on solution-focused strategies for health and well-being. Now I turn the program over to JNF's Director of Plan Giving Midwest, Bill Adolph.
Thank you, Marna. It's my pleasure to introduce Mitch Weinstein, President of Chuhak Tecson, and Lindsey Paige Markus, a principal at the firm. Mitch is a seasoned business, tax, and estate planning attorney, the practice group lead of the firm's corporate, transaction, and business law group. He's been a hands-on leader for the firm for many years. His practice encompasses a wide range of estate planning, federal and state taxation, general, corporate, and real estate transaction matters. Lindsey assists business owners and families in planning their estates, protecting their assets, transferring wealth, and minimizing taxation. She works closely with clients to formulate succession plans, advise on business formations, maximizes wealth preservation, and minimizes estate and gift taxation. Thank you both for being here today, and turn it over to you.
Thank you, Bill. Much appreciated. I'm going to be sharing a screen for our presentation, so hopefully that's going to work for you. So I put a little subtitle up here on to change the laws or not change the laws. I was certainly hoping maybe a month and a half ago or 2 months ago when Bill reached out to us about giving this presentation that we might have a lot of changes in the law. It certainly looked like that was going to happen. As we sit here on November 16th, there was a huge infrastructure bill passed yesterday that had almost no tax changes whatsoever in it. There's certainly a lot out there, and we're going to be alluding to some of the things that might happen. Back in early September, it looked like there was going to be a lot happening. And then more recently in October, most of that just disappeared, and we're not sure what the end Build Better Back package might look like if and when it ever gets passed. So we're going to talk about what we can. And what we maybe allude to some things that might happen, but we'll deal with what we know as opposed to what might actually happen or not happen. So so there's some things for this year that are no different than other years. There's some things that are special for 2021 that might not be applicable in other years. So the very common planning we tell people at the end of any tax year is, hey, if you don't want to pay taxes this year, maybe you can accelerate some of your deductions into the current year. And if possible, defer some of your income into the following year. And in most years that will work. And that's a great planning opportunity. But in some years, maybe that's not the right move. Maybe the opposite move is a better strategy. Maybe you actually want to pay some tax this year because you think the rates are going to be lower and rates are going to go up next year. So maybe it's worthwhile to pay a little bit more tax this year at a lower rate and push some income into next year where you pay tax at the higher rates. So, and then you ask yourself, are you in a higher tax bracket this year than you're going to be in next, or vice versa? So those are a couple of the questions you just have to evaluate for yourselves and determine what makes sense for you, if there's any planning opportunities between now and the end of the year. And the age-old question is, well, will taxes be higher next year than they are this year? Will rates go up? Unknown. Obviously, we don't know that for sure, but I'm fairly certain rates are not going down. That much is pretty clear, that there's nothing pending that's going to suggest that tax rates are going down in 2022 with the administration in place and the proposals that have been forthcoming. So that's just something to think about where possible between now and year end. We're going to talk a bunch about charitable contributions. One thing I do want to mention is, in recent years, only those that get to itemize their deductions get to take advantage of a charitable contribution tax deduction. That currently is not the case. There's a little window here of time for even those people that are not able to take advantage of itemizing their deductions can still take a charitable contribution deduction. It's not huge, but it's there, so it's something to consider. $300 even for a single person, $600 if you're married filing jointly, and that's available right now. It's not going to be there forever. It's we think it's ending at the end of this year. I'm not sure it's going to come back, but there's some caveats to it. Unlike certain other charitable contributions, you can't just leave your stuff out for Goodwill or someone else to pick up at the front door. It can't be property. It can't be things. It has to be cash. It has to be credit card, debit card, no property donations, not even stocks. And it has to go direct to a public charity. So you can't, for this particular deduction only, you can't make your donation to a foundation or a donor advised fund. So there's a limited opportunity here for some people that aren't taking advantage or aren't able to take advantage of those itemized deductions. Also, we're sitting in a position right now where there's really, I won't say there's no cap, but the cap on cash contributions to charities, which has over the years been limited to 50% or even 60% of your adjusted gross income. For 2021, it's 100% of your adjusted gross income for a cash contribution to charity. So something to consider if you're thinking about making a large donation before year end, and it might otherwise be subject to limitations on adjusted gross income. Right now, that limit is at 100%, which is obviously very favorable for making donations. For those that are participants in retirement plans and are of the appropriate age, over 72, which is the current law, and are now required again in 2021 to take your required minimum distribution, sometimes called the RMDs. You may recall that back in 2020, those were put on hiatus for a year when the pandemic hit. The CARES Act came out. They shut down the need to take any required minimum distributions. Well, that of course is that was 2020, and we're in 2021, and you do have to take your RMD this year in one way, shape, or form. Some other qualified medical expenses. So not a lot of people want, even those who itemize deduct medical expenses. It's really for people because of this threshold where you have to have at least 7.5% of your adjusted gross income. Most of our healthier, younger people will not need that, but some people will, of course, itemize their deductions. One of the things that changed is that PPE qualifies as a medical expense for this purpose, even if not particularly prescribed. But there is some planning of maybe you may bunch some of your medical expenses where possible. Most people don't necessarily think that way, and medical expenses aren't one you say, can I wait to do them all at once, all my elective procedures? Sometimes I get a little queasy thinking about bunching elective procedures because I don't really know what exactly people bunch together to all take care of at once. But there is an opportunity if you think you are in the right, if the right number of expenses out of pockets compared to your income, it can all be bunched into a particular year so that you can get some benefit from it. Back in 2020, for self-employed individuals, there was part of the law that was passed, the huge CARES Act, was that anybody that was self-employed that had to pay a portion of their tax, self-employment tax, the Social Security portion, was allowed to defer it. So you didn't have to pay it back in 2020, but that deferral was not permanent. So you have to repay, if you deferred anything from 2020, you have to repay half of it by the end of this year, by 12/31. So it's kind of a reminder for anyone that applies to, you've got another 45 days or so to make your payment. Annual exclusion gifts. So this is a little bit, I mentioned this here. So in the gift tax arena, we're not talking about income taxes, you can gift as much as $15,000 to any one person in 2021. You can gift to as many people as you want, $15,000 per person. With a married couple, you can double that number. But that's not you don't get a tax deduction for that. Nobody gets if I make a gift to my son of $15,000, I do not get an income tax deduction for that. However, I've now moved $15,000 off of my balance sheet and onto the donee's balance sheet. So to the extent that I can make $15,000 invest and make some more money off it, and any future income on that $15,000 is going to be at the donee's tax rates and not at my tax rate. So while annual exclusion gifts themselves are not necessarily an immediate income tax impact, over time, they can certainly be very powerful and even save income taxes for individuals and families. So something to think about. So charitable donations. So I just talked a little bit about for those that don't itemize, but for larger charitable contributions, charitable donations make for powerful planning. We've been talking for the last couple of years, ever since the larger standard deduction went into place for folks. Not everybody is itemizing. People that make a modest, some charitable contributions, but not a large amount, aren't getting the benefit of a tax break in many years. So one of the things to consider is bunching those donations, just as I talked about earlier a little bit with medical expenses. You can bunch your charitables into 1 year to make sure that you can take advantage of the tax deduction. So if you are splitting your charitable contributions, and maybe you're making them at $10,000 per year, maybe you're not hitting the standard deduction and you're not getting much of a benefit at all. But if you pushed it and did $20,000 in 1 year and then zero in the next year, at least that year you're making a $20,000 donation, you'll get some tax benefit from doing that. And the bigger the numbers, the bigger the tax break that would occur. And keep in mind, as I said earlier, that the contribution deduction limits at 100% of adjusted gross income for this year make it more advantageous to push it into 2021 if possible, because those limitations are not going to be as high next year, absent some unexpected change in the law. This has always been a good planning opportunity. Nothing special about 2021 necessarily, but donations of appreciated stock to charity are always a great way to make a donation. So if you're sitting on a stock that's been appreciated, you got a lot of gains if you were to sell it. If you would go sell that stock, take the proceeds and donate that to charity, you've incurred the capital gains. However, if you don't sell the stock first, but just donate the stock directly to the charity, you don't trigger the capital gains, and you get a fair market value deduction for the stocks that have been held for more than a year. So there's definitely a planning opportunity, and it's pretty much, I won't say exclusive to publicly traded stocks, but it's pretty much exclusive to that arena, and it's a great planning opportunity in any year, including 2021. The flip side of that is, with the markets on the rise, you don't see a lot of people sitting on lost stocks, on depreciated stocks, but nonetheless, some people may have those in their portfolio. And if that is the case, just the opposite concept applies, which is you'd actually would want to sell that stock first so that you can trigger a capital loss, and then you can donate the cash proceeds to charity. So as opposed to, you wouldn't want to donate the depreciated stock to charity directly. You'd want to sell that stock first and donate the proceeds to charity. So just something to consider. Capital losses can offset capital gains up to a certain amount. And then, while you're only allowed to offset $3,000 of capital losses against ordinary income, those can carry forward for an extended period of time. But in the meantime, just do not donate your depreciated stock to charity. Sell it first. But coupled with that, if you are sitting on, as I talked about earlier, and you've got thinking about making donations to charity, coupled with the fact that you do have to take an RMD in 2021, as I said earlier, why not consider taking your RMD and donating donating that RMD directly to charity? So rather than taking the RMD yourself, putting it in your pocket and cutting a check to JNF, why not take go to your custodian and say, I want to make a donation directly to JNF? So why do that? Because the donation doesn't count towards your income at all, and you don't have to worry about itemizing your charitable deductions. It's just completely excluded. It counts towards your RMD, but it's excluded from your taxable income. So this is a very favorable tax provision that's been out there for several years now, or many years now. It used to be one that they would have to extend year after year, or it was going to expire, or they'd extend it, extend it. Thankfully, they've made it a permanent one, and that's a good thing for individuals. I would note that it does need to be to qualified charities only. You cannot make this particular donation to a donor advised fund or private foundation, similar to something we talked about earlier. There are some limits on where you can make these. So public charities need to be the recipients of these direct donations from your IRAs. So is 2021 a year to recognize capital gains? So there's been a ton of talk about whether tax rates are going up, right? It's been rumored for quite some time right now. So is this the year you should actually trigger some gains? Certainly, if you can gift appreciate, so capital gains rates are 0, 15, or 20, depending on your income tax bracket. And I'm ignoring state income taxes altogether. Some of us are in a state that taxes income. Some of you are in states that do not tax income. So capital gains we're just going to use the federal brackets for this purpose. So what should you do in 2021? One thing to consider is that the Biden administration proposed early on that they wanted to see capital gains go as high as 39.6% for people in the higher income tax brackets. That was on the table. They wanted to match capital gains rates with ordinary rates for people in the high tax brackets. More recently, Congress proposed, and not necessarily going to happen. More recently, they actually proposed 25% as the top capital gains rate. Keeping in mind for people in the higher tax brackets, that's 25% plus 3.8% for the net investment income tax. So we know that the rates capped are out right now at 20% plus that 3.8. Is it going to go to 25? Could it go higher? Unclear. As I said earlier, it's not going lower. I can promise you that. And is it make sense to incur the gains this year while the rates are lower? Certainly something to consider. And just as a reminder, these capital gains rates are for long-term capital gains. They have to be assets you've held in your portfolio or in your coffers for at least 12 months. Short-term gains, things that you've just bought recently, spiked, and you want to sell them and cash in the profit, you do not get capital gains rates on those. Those will be taxed at whatever your ordinary income tax rates are. So don't go out and sell some stocks that just appreciated a whole bunch in the last few months and say, hey, Mitch told me I should do it. I'm going to get capital gains rates. So short-term gains aren't going to get that benefit. But it does appear right now that capital gains there's reasons to consider triggering some gains in 2021. Again, not necessarily going to be higher rates coming forward, but it's a distinct possibility. There is up at the top here, I did mention that if you do have appreciated stock securities, and as I talked earlier, you could donate those to charity, but also maybe you want to donate those or gift those to relatives in a lower tax bracket. So if you know somebody who's in a 0% or 15% tax bracket and you gift them the securities and they trigger the gains at their level, you could avoid some of the taxes altogether or tax it at a lower rate if they sell the securities as opposed to you selling them. So something to consider as well. Are you an employee? Are you working for an employer? Are there other things you could be doing to sock away some money, take advantage of some of the tax provisions in the code as an employee between now and the end of 2021? The 401k, are you a participant in a 401k plan? Have you maxed out? Have you at the current numbers for 2021? It's 19,500 of your own income. Plus, if you're 50 or more, you can put in an extra 6,500 to get to 26,000 for 2021. There's still time to do it. While many people take out some money from each paycheck, you don't have to do it per paycheck. You may be able to say, hey, I'm going to get a year-end bonus and I'd like to contribute it all to my 401k. So just try to max it out, take advantage of what you can when you can do it. Healthcare, if you're a participant in a flex spending account, this is probably not one you can really adjust at this moment in the tax year. Most people can't do it right now, but just something to keep in mind maybe for this year or next. Certainly you want to spend, if you've got your money in a flex spending account, you do want to spend it as much as possible because flex spending accounts are use it or lose it. So this is basically you're setting aside some of your income into an account to be spent on certain expenses, medical or otherwise cover certain out-of-pockets. But again, it's use it or lose it. So you want to make sure you take advantage of it. Dependent care, similar if you can set aside some of your wages into a dependent care program. And as these things all assume that your employer offers it. The limits for 2021 are at 10,500. We always recommend people max out on all the available tax breaks you can, whether it's flex spending, dependent care, commuter, parking, et cetera. Take advantage of what's available to you. Otherwise, you're spending after-tax dollars to do that. And why do it if you don't have to? For some people, if you are covered, we talked about health savings account. Unlike a flex spending account, a health savings account, you can carry over unused balances. It's not a use it or lose it, but these are very powerful tools as well. If for those that are covered again by if you're in a qualified high deductible health plan, you should be able to contribute some income to this health savings account or make a deductible contribution to set it up yourself. The beauty of this is, you can, let's say, as the numbers here show, 2021's cap on a family is 7,200, single 3,600. You can invest these funds. So if you invest a $7,200 contribution, it can grow and grow and grow over time, only to be used eventually for medical expenses when you actually need it, but it grows tax-free. Just like an IRA, it grows tax-free. And as long as it's used to pay for qualified medical expenses, it doesn't get taxed, even the growth on it. So a very powerful tool for those that are willing and able to do it, and it can accumulate some funds in there over a period of time. Retirement plans in general. So as I mentioned before, you definitely want to max out if you're a 401k, but if you're not in a 401k, you're not a participant in a plan, you still have an opportunity to contribute to an IRA because you're self-employed and making some income. Definitely want to make your contributions before year end. $6,000 is the max deductible amount in 2021, plus another $1,000 if you're age 50 or more. So something to consider. Something else to consider that gets talked about a fair amount, but not everybody does it. But should you consider converting a traditional IRA to a Roth IRA? This has been out for quite a while. The longer you wait to do it, the less the benefit. Quite frankly, the sooner you do it, the better the benefit. You're not required to. It's something that people don't always know. You're not required to convert your entire IRA to a Roth. You can do partial conversion. Some people, people do know that this will. When you do the conversion, as this bullet point says, you're going to accelerate the tax on the traditional IRA, and you have to reach into your pocket to pay that tax. By doing a partial conversion, you're definitely incurring less tax, right? So if you're going to convert a third of your IRA this year, then you're only going to incur a third of the tax. So, but when you look about the long-term benefits over time, it definitely works. The numbers definitely play out. As my colleague Lindsey likes to tell me, it's a prepayment of income tax at a discount. So that's what's in here. So that's really what it is. You're prepaying some income tax, but the benefits over the long term are substantial. And as long as we're talking about retirement plans generally, certainly want to consider at all times reviewing your beneficiary designations and make sure they're up to date. And quite frankly, when we talk to our clients who are not only worried about income taxes, but also estate taxes and have charitable inclinations, make the charity the beneficiary of your retirement plan over the long haul is the best result for tax purposes, rather than having your family members receive a taxable IRA and contributing from your estate non-retirement assets. So it's just a great tax planning strategy, and it's universally recommended, but not everybody knows about it and does it in a timely fashion, unfortunately. So one more thing I want to talk about. So before I turn this over to my colleague Lindsey. So in recent years, we talked about itemized deductions. State and local taxes, which is what's here on SALT, have been capped as an itemized deduction. So when they increased the standard deduction so that less and less people are able to itemize, they simultaneously capped the amount you could take as an itemized deduction for state and local taxes. And it's capped at $10,000 per year. Those two combination of things, the standard deduction going up and the state and local tax cap going into place, resulted in a lot of people no longer being able to itemize their deductions. That's just been the result. So over the last few years, states have looked at this and said, wait a minute, we don't like this. This isn't best for our folks. We want to find a way around this. Is there a way we can get state and local tax deductible to our constituents, to the people living in our state? So a number of states have adopted a mechanism to work around the SALT cap that the feds put in place a few years back. And this has been now blessed by the Internal Revenue Service, at least this general strategy. And really what you have to do is you have to be in a position to have a flow-through business entity, like an S corporation or a partnership or an LLC that's taxed as a partnership. And the key here being is that the business entity, unlike individuals, is not subject to that same cap. So that business entities don't have that $10,000 cap on deduction of state and local taxes. The businesses can pay their state and local taxes and take a deduction at whatever the amount is. So the concept is the business entity will pay the taxes on behalf of its owners, and they can pass on the tax payment via K-1, which is the way a flow-through entity passes out its income tax and deductions to its owners. So this isn't a simple workaround. This isn't something that, I've just in about a minute or two just told you about a workaround that is somewhat complex, requires some people to form a new entity, form a new business, maybe incorporate. If they're not incorporated, it requires you to do some things that you definitely want to consult with your professionals. And very importantly, make sure your state actually has adopted this as an avenue, because not all of them have done so. So I bring it up because Illinois just did it in 2021, even though it's not effective till 2022. So it's out there for us in Illinois for next year, and I just wanted to mention it. So I've had a whole bunch of things in a short period of time, and I'm going to turn this over to Lindsey quickly. So just remember, when you're doing these things, again, just as this last item said, hey, always consult your tax advisors, your professionals, as they can be more in tune to what your individual circumstances are. So with that said, I turn it over to Lindsey to talk estate taxes.
Wonderful. So As if the presentation on income tax planning wasn't stimulating enough, I now have the wonderful pleasure of talking to all of you about death and taxes, a killer combination. It's been a wild and crazy couple of months, 18 in fact. I'd say the pandemic has kept us incredibly busy, just with respect to general estate planning from the perspective that individuals with modest estates, the pandemic and COVID has highlighted the importance of getting your ducks in order and planning and making certain things are in place. And then for high net worth individuals, we've been in what we thought was a race against time, which we have a little bit longer to run in the race, which I'll get into, in terms of utilizing some of the estate and gift tax benefits. So let me try and help provide some level of context for the conversation. So in our world of death and taxes, we often talk about what is the size of someone's taxable gross estate. And think about that as anything and everything that the decedent, the person who died, had what they characterize as incidences of ownership or control over throughout their lives. So obvious assets, cash and marketable securities, real estate, insurance, trust assets, annuities, the list goes on and on. But one asset that's often overlooked really relates to insurance. Life insurance is often marketed as being a tax-free planning vehicle. The death benefits are always income tax-free, but whether or not they're estate tax-free is really dependent on how the policy was owned. So imagine that I have a $2 million life insurance policy on my life that's worth nothing right now. If I die during that term, even though it's worth nothing in this moment, if the $2 million is paid out to my beneficiaries, the IRS includes that $2 million in my taxable gross estate. So now that we have a framework for understanding how we compute the size of your estate, let's think about how much we can pass estate tax-free. Based on the year in which you die, the government allows you to pass a certain amount of money tax-free, and we call that the exemption. What is exempt or free from taxation? Right now in 2021, the exemption is $11.7 million. How did we get to that interesting number? Well, the exemption used to be $5 million. The Trump administration, in essence, doubled the exemption to $10 million adjusted for inflation. So we get to this figure of 11.7 million. This race against time that I was talking about before was really premised on the fact that even if Biden and the Democratic Party are not successful in changing any of the exemptions between now and 2026, automatically the tax code is scheduled to sunset and drop back to the $5 million threshold in 2026. So the exemption, regardless of what happens in Washington today or tomorrow, in 2026 is scheduled to drop in half. Many of us, myself included, assumed that the Democrats would be successful at changing the exemption, that tax-free amount, effective January 1st of 2022. And in fact, that was part of Biden's initial proposal that he had released in mid-September, along with a plethora of other confusing proposals, none of which went through. So why are we in this race against time? Well, the IRS says that either I can die with that amount in my taxable gross estate this year, or I can gift that amount. And if I gift that amount, it's the idea that we want to use it or lose it. That if I'm fortunate enough to have what we characterize as a taxable gross estate, more than $11.7 million, to the extent that I can effectively gift those assets to individuals or likely trusts created for the benefit of other individuals, I have doubled the amount that I can effectively pass tax-free to my family, because there is no clawback if at the time of my death I have less than that amount. For anyone that's interested in learning more about that, I'm happy to share an article on it. But it's this use it or lose it mentality that if I don't gift the $11.7 million, I will have lost the opportunity to pass that amount upon my death. At the end of October, Biden came out with an update regarding his proposed legislation, and none of the conversations around the estate tax changes that sent us into a tailspin in mid-September were included. So just last week, the IRS released their adjusted numbers for inflation for next year. So next year, if an individual dies, or if he or she is interested in using their lifetime exemption, it's scheduled to be $12.06 million. That is per person, so we can double that exemption with proper estate planning for a married couple. Another key thing that you need to look at and consider is whether you reside in a state that also has its own estate tax, where there's a tax levied at the estate level, or whether or not you're subject to an inheritance tax. In those states, if I am the beneficiary of an estate plan, and I am the inheritor, the person who's inheriting the assets, I could be subject to having to pay some level of tax. Another thing that has been top of mind, especially while the exemption is so high, is this concept of portability. And portability really opens the door for married couples to leverage use of their respective exemptions at the federal level. So imagine that I'm married to Brad Pitt, and with my luck, we can all assume that he's not the uber successful star that he is, but most likely a struggling actor. So if Brad and I are married and he passes away this year with next to nothing except for the $1 million life insurance policy that I made him buy, his taxable gross estate would really only be $1 million. So if he passed away this year, we would have lost the ability for him to pass an additional $10.7 million estate tax-free to our children. What portability allows us to do is, me as his surviving spouse and executor of his estate, if I timely file an estate tax return, I can capture his unused exemption and port it onto my return. So that if in my delusional hypothetical, I have a taxable gross estate in the future and the exemption or tax-free amount is only $5 million at the time of my death, I could effectively pass $5 million, which is allotted to me, along with the additional $10.7 million that I ported from Brad's estate. Portability is only applicable, typically only applicable at the federal level. Most states do not recognize it. So you still need to make certain that you're being efficient with how you're handling any estate tax liabilities at the state level. So, I had mentioned this concept of gifting and how the last 18 months have been an absolute whirlwind. And it's been frustrating to us as practitioners because it's no surprise that based on the nature of my practice, estate planning, I am a planner by nature, and I only wish that my clients would follow my advice sooner rather than later. So Mitch had mentioned previously that on an annual basis, you could gift $15,000 per person per year, or $30,000 for a married couple. Again, the IRS released those adjusted numbers next year, which will be $16,000 per person or $32,000 for a married couple. This too has a notion around it of use it or lose it, that if I don't make a gift this year of $30,000 or I'm single, so $15,000 per person, I will have lost the opportunity to make those tax-free gifts. It's not as if I can go back 5 years from now and say, you know what, I really meant to gift $15,000 a year to my brother. There's no catch-up. So you want to take advantage of that to the best that you can. And as I mentioned before, we're also seeing more and more clients take advantage of the lifetime gifts, which is another use it or lose it phenomenon. That if I don't take advantage of the exemption while it's set at the rate that it is, I will have lost the opportunity to pass it. I think one of the reasons why we tend to be so frustrated as practitioners that clients don't engage in these gifting vehicles sooner rather than later is really based on the fact that when you look at the time value of money and what the future value of gift would be. So imagine that I am incredibly grateful for Mitch being my president, a wonderful next door neighbor at the office, and professional colleague, and I want to gift him $1,015,000. The first $15,000 would be a freebie. The additional $1 million would use up a portion of my lifetime exemption, and we would have to file a gift tax return to notify the IRS that I've used up $1 million of what I'm authorized to pass in the future at my death. So if I died when the exemption was $5 million, the amount that I could pass additionally to that $1 million that I gifted would only be $4 million. So we have the 5 million less the $1 million that I gifted. But the real benefit to gifting is that we're gifting not only the current value, but also the future appreciation. So imagine what that gift of mine to Mitch of $1,015,000 will be valued as of my date of death. When we layer in more opportunities to incorporate trusts involved, I could create a trust for Mitch's benefit, known as an intentionally defective grantor trust, whereby all of the income tax attributes flow back to me. And then if I was feeling incredibly generous over the course of the life of the trust, each time there's an income tax liability and I pay that tax, it's another free way for me to help reduce the size of my taxable gross estate while increasing the value of the gift. Again, if you live in a state with estate tax or inheritance tax, the benefit of gifting grows exponentially. Although the states require us to take into consideration how much you gifted of your lifetime exemption, when you run the calculations, looking at a comparison of what my taxable gross estate, for example, might be if I lived in Illinois, where the tax-free amount is only $4 million. So imagine I lived in Illinois and I died with $5 million in my taxable gross estate and made no lifetime gifts. My estate ends up paying more estate tax than it would be the case if I died with $4 million and I had gifted $1 million over the course of my lifetime. The taxes on average when at the state level tend to translate into about 10% of estate tax savings at the state level. And the only way you can really make sense of this is to go on to your respective like Secretary of State or Attorney General estate tax calculator and play with the numbers, perhaps with a nice bottle of Mogan David. It's a whirlwind for sure. So as if we didn't have enough going on with the backdrop of the pandemic, and then in Illinois, to add insult to injury, they changed the trust laws dramatically, so much that they changed the name of the trust laws. The federal government also made effective the Secure Act, which impacts just about everyone and everything in connection with IRAs. So the Secure Act, the acronym stands for Setting Every Community Up for Retirement Enhancements. I would respectfully disagree. I don't see tremendous enhancements. I see enhancement opportunities for organizations and nonprofits like JNF, who will hopefully benefit from donors and individuals learning and understanding how they can increase their estate tax planning and minimize income taxes by incorporating a charity. One of the big changes that we saw was, of course, given the fact that people are living longer and retiring later, even individuals employed who are over age 70 and a half can still continue to make contributions. They can continue to make contributions to IRAs, even over 70 and a half, regardless of whether they're working. And in addition to that, RMDs no longer have to be started at 70 and a half. To the extent that you'd like to start them at 70 and a half, you can. There's no penalty for doing so, or else you can wait until they're 72. Where we get the biggest headaches, and it's not just the attorneys, it's the CPAs, it's the wealth advisors, and it's the individuals contributing to these accounts, is what are we doing with beneficiary designations? The biggest problem that we've run into, or the biggest change, is that there are now tremendous restrictions on inherited stretch IRA opportunities. So under the old laws, if I was a beneficiary of an IRA or 401k from a family member other than a spouse, and I'm over the age of majority, clearly, we used to be able to look at complex tables published by the Internal Revenue Service to determine what my life expectancy is and how much I need to withdraw on an annual basis. So we would effectively stretch the IRA distributions over that time period. Now, for most individuals, unless they are considered an eligible designated beneficiary, such as a surviving spouse, a minor child, a disabled individual, or someone who's within 10 years of the original owner, the IRA needs to be cashed out within 10 years. So I can no longer stretch my inherited IRA over my life expectancy. It has to be cashed out within 10 years. The insurance industry has loved this. Many of the brokers that are sharp are starting to market life insurance as not only an estate tax replacement vehicle, but also as an income tax replacement vehicle. So we know that at the time of someone's passing, the beneficiaries are going to be subject to these income taxes from the retirement plan distributions. So here's this influx of life insurance to help cover that. As Mitch had mentioned before, we're encouraging more and more clients to consider converting an IRA to a Roth IRA. And I can't underscore the benefits of considering and being strategic in terms of charitable planning with retirement plan assets. I've had many clients who now understand the income tax implications in connection with retirement plan assets, and they've elected to create a family foundation, or even more popular, a donor advised fund. I believe JNF professionals are going to talk more about the JNF platform and how that can be utilized. But it's the idea that more and more clients are looking to a donor advised fund as a way of considering it more or less akin to your own family foundation without all of the legal work, administrative reporting, annual tax reporting, or anything of that sort. It also provides a wonderful vehicle for the bunching that Mitch had discussed previously, in terms of bunching your charitable deductions to try and maximize the beneficiaries. But the real reason why it's so beneficial for IRAs is, imagine there is $1 million IRA, and I am a beneficiary of it. Again, I'm not a surviving spouse. If the estate was subject to estate taxes, when we combine estate and income tax considerations at both the federal and state level, the amount of tax for an IRA that's traditional, not a Roth, can be in excess of 70%. So of $1 million IRA, I might only net $300,000. Whereas if that $1 million IRA went directly to JNF as a nonprofit, or went directly to a donor advised fund managed by JNF, that organization, that nonprofit, or that donor advised fund gets the full $1 million. And I think this is more and more why we tend to be frustrated when clients aren't thoughtful and considerate in terms of which assets they're leaving to whom. There's one more thing I want to talk about on the Secure Act, and that really relates to beneficiary designations. As Mitch mentioned before, we can't underscore more the importance of checking beneficiary designations on your estate planning documents, but also life insurance and retirement plan designations. So in my delusional hypothetical where Brad Pitt and I run off in the sunset together, if Brad forgot to update the beneficiary designation on his IRA and it's still listed Angelina Jolie, or even worse, Jennifer Aniston, that is where the money is going. So you need to check that. To the extent that you're not looking to be charitable at this time or leave the assets to a nonprofit, again, it doesn't have to be some or all or nothing, it could be some. I'd encourage you to talk to your attorney and CPA, look at and wealth advisor for that matter, look at the totality of the retirement plan assets to help determine whether or not it makes sense to leave the assets directly to beneficiaries, or for the beneficiaries to inherit through trust to maximize wealth transfer tax planning, as well as asset protection. And I want to make certain, especially in light of the fact that so many of you, by virtue of being on the distribution list for JNF, understand the importance of tzedakah and philanthropy. I think you need to not only think about how much I want to leave to a particular organization or community or whatever legacy you're looking to leave, but more important, which assets. Because if you are strategic in identifying specific assets in a tax efficient way, it's almost as if we have the opportunity to grow the pot of available resources for family beneficiaries as well as philanthropic. Over and over, I review estate plans for clients that have specific bequests, specific distributions of $10,000 or $100,000 to JNF. If those distributions are listed in your will or trust, the process that the executor or trustee needs to go through is to first liquidate assets and then send the check to JNF. In contrast, if the charity is listed as the direct beneficiary of a taxable IRA, we get to save and not have to pay any of the income taxes on those IRA assets. Even when I'm doing that, though, I always want to make certain that my strategic planning doesn't inadvertently disinherit a charity. So what I like to do is I like to work with the client to designate a certain percentage to be left to JNF, and then in their trust to also have a savings clause, which would say it was the grantor's intention to leave $100,000 to JNF. That amount, however, shall be reduced by any amount passing to JNF by virtue of the beneficiary designation. So in that way, if JNF already received $80,000, they would get a true up of another 20. Life insurance is another wonderful way to think of reorganizing or leaving assets to a charitable organization. Retirement plan assets that we talked about, the tax savings grow exponentially, and it's a wonderful way to leave a legacy to the community. So with that, I think we're ready to open it up for questions.
Mitchell and Lindsey, thank you so much. My name is Cynthia Hazami. I'm the Director of Plan Giving for the West Coast, and Robin Dermer, who's Director of Plan Giving for Florida. We're going to go through some of the questions. We had quite a few. I want to just say right off the bat that you did a great job, and thank you so much. If we don't get to all of the questions, we will get back to you individually. So we may not honestly get through all these questions because there are very many. So one of the questions had to do with the charitable contribution, $300 charitable contribution. That is total, is that correct?
Yes.
Yeah.
Yes, I see the chat. It's not per charity. It's a total.
And then somebody asked about the RMDs, and somebody else had chatted me individually if you might want to comment on what age do you have to take the RMDs and what age can you use the qualified charitable deduction, and does that include inherited IRAs? That comes up for us quite a bit.
Got it. So it's in typical government fashion. They took something that was consistent and said 70 and a half was the age for required minimum distributions, and it was the same age for the direct distributions to charities. They went ahead and changed one, but not the other. They changed the required minimum distribution age to 72. Back, this is part of that Secure Act from that was passed at the end of 2019. So effective in 2020, it was the triggering age for required minimum distributions was 72. For those that are over 70 and a half, if you want to take a required minimum distribution or any distribution and give it directly, a required minimum distribution, give it straight to charity, you can do so through that qualified charitable distribution direct from your IRA to the public charity. So that age is still set at 70 and a half, which is, I know, peculiar, but I believe that's something that needs to be fixed or corrected, but that's how it's still worded.
And so the qualified charitable deduction is not available for somebody under the age of 70 and a half, right?
Correct.
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 But it does count even if you inherited the IRA, as long as you're 70 and a half?
I believe that's correct. I would double check that, but I believe that is correct.
Yes, well, yes, I
Yep.
believe so too.
Yep. Yep.
Somebody did comment about documenting the annual gift exclusion.
So if it's a cash gift of some sort, within the annual exclusion amount of $15,000 per person or $30,000 for a married couple, you just write a check or transfer securities within that amount, assuming it's within that threshold, and there's no additional documentation or gift tax reporting that is required. To the extent that this is a regular occurrence and a client doesn't have such mazel with the IRS and might be susceptible to audits, it's always recommended to keep something in your record, some note, a memo to yourself, or a note in the memo line of the check, so that in the unfortunate instance of an audit, you have some recollection of what was going on.
Great. Do you want to maybe comment? Somebody asked about if you're converting a traditional IRA to a Roth IRA and you need to offset some of that income tax during the term, is there a good or a better way, I would ask, to do that in terms of charitable gifting?
So I'll
that you
say
need?
that Mitch might have some other ideas, but I'll tell you that I have been recommending Roth conversions so much that one of the benefits of being on Zoom is that when we start talking about the income tax liabilities that the clients are going to have to pay, I don't have to worry about them like throwing something at me. The taxes are big. They're big. But if you work with your financial planner, CPA, or attorney to model the tax savings over time, they are tremendous. Mitch and I took some artistic license with one another's slides because normally we do this more conversationally, but in the Zoom environment, we thought that would just be awkward. I often characterize it that when you're paying that income tax, you're prepaying it somewhat hopefully at a discount, because we think tax rates are going to go up. And the amount that we will be paying on tax in the future will also go up as the principal increases. Then from an estate tax planning perspective, let's say I convert $1 million IRA and the income tax liability is $350,000. When I pay that tax, that's a free way for me to move more assets outside of my taxable gross estate. So one tool that we recommend on a regular basis is in a year when clients are considering doing this, to also work with their tax advisors to be strategic in terms of how can we look to offset that large taxable gain. Donor advised funds are a phenomenal planning tool. And what we often encourage clients to do, especially as we start in these conversations in November of this year, contact the organization, whether it be JNF, to open up a donor advised fund as soon as you can, to have it up and running, then work with your CPAs and your wealth advisory team to identify assets that you want to gift, to Mitch's point of what he discussed previously, gifting those appreciated securities to the donor advised fund. But chances are that your team, if you're just deciding this right now, they're not going to be able to tell you today what the magical number was. Don't let that stop you. Get the donor advised fund in place now, and then, play around with the numbers with your team. And then Mitch might have some other ideas.
No, I think you've hit them. You definitely covered them all.
Well, thank you, Lindsey and Mitchell. I will say that we do actually have a donor advised fund, and our minimum gift to open the fund is $10,000. Our fees are a fraction of what other organizations and banks and brokerage houses charge. We offer 6 investment pools, and they range from money market to aggressive growth. While you don't get an extra deduction for the gain in the account, you do get to use it for your charitable purposes over the term of the account. You also can appoint a successor grantor or grantors, whether it be your children, your family members, who can carry on your wishes even after you're gone. And in fact, they can do it jointly and severally or individually. It's really your choice. We do ask, because of the very low fees that we charge, that at least 15% go to Jewish National Fund programs and projects over the term of the fund. So not in the year of the gift, not year to year, but decades down the road. If you put in $100,000, we would ask that at least, for instance, $15,000 go to Jewish National Fund. I think it's a great way to keep your philanthropy within the charitable world. If you open a donor advised fund, for instance, with a bank or brokerage house, you realize they are making money off you. The largest charity in the United States right now is Fidelity's donor advised fund. They have billions of dollars in it, and they charge around 0.6% for just their administrative fee, which, 0.6% of $25 billion is really quite a bit of money. So if you want to keep your charitable dollars within the charitable world, we'd appreciate you reaching out to us. And the other thing I want to mention, Lindsey and Mitchell had talked about estate planning. We have at Jewish National Fund USA have teamed up with the Jewish Future Pledge, which is a nonprofit, nonpartisan organization out of Florida. The goal of that organization, and our goal, quite frankly, is to ask that if you are leaving any charitable dollars in your will or trust, that you commit half of those dollars to Jewish causes, not necessarily Jewish National Fund, just Jewish causes. It's not binding. It's completely voluntary. You can be anonymous. It's just to get people thinking about the future, our Jewish future, the future of the land and people of Israel, and not just in the next 10 years, but in the next 4, 5, 6 decades. We obviously at Jewish National Fund find that very significant, and just knowing that you're on the phone with us right now on the screen, it makes us realize that it's important to you also. So if you have any questions at all, please contact my information. Robin's and Bill's will be in the thank you email that you'll receive. Please give us a call if you have any questions. And if we did not get to your questions, we will contact you directly. So thank you so much for today. We just really appreciate your time.
Thank you.
Thank you. Mitchell and Lindsey, thank you so much. It was so great. Really, just so great.